Hello, I am Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Previous videos I have been discussing the technique of preloading, and I want to continue that discussion today by talking about some of the more unpleasant side effects of it. Now, preloading can be a very powerful technique for making money, but it has a dark side to it that really needs to be discussed in terms of just how reliable of a technique it really is. As I've demonstrated previously with Australian dollar, US dollar, the sell-off of 2.5 times or 61 trades brought in literally a huge amount of profit in a 24-hour period. A staggering amount, to be quite honest. But that problem gets exacerbated when you see the true point of view of the cost of that process. And that is what we are going to discuss right now. So we are looking at Euro franc as the example. We see where the preload took place and just how much it racked up. And we see how the grid expanded, taking a stop loss for every one of these positions, which is all fine and well. You expect this grid expansion. It's just part of the process. But the problem that you don't see right away, and the problem of when preloading takes place, is where are we at in the bigger picture? If we're at the top or the high of the chart, and you're in a short level trade, then preloading at the top and writing it down is a wonderful bonus. But if you're at the bottom of the cycle where prices are likely to climb higher, then you're going to find the bite to be extremely painful. And that really is the downside of preloading. Preloading always gravitates to the direction you want to trade. And as we can see in looking at a significant history of this chart, we are at the bottom of the traffic. That is, all of the benefits that we could have gained from preloading have just been wasted. And now we are going to take excessive stop losses as the asset climbs back up to the top. Preloading works great if you're up here. Preloading burns if you're at the bottom. So it's one of those gimmicks that if you happen to be in the right place at the right time, it can really bring in a very nice little tidy sum. But the truth is, most of the time, the market isn't in that kind of a situation. You're not in the right place at the right time, and you're usually going to end up giving back more than you're going to receive. And I'm going to demonstrate that with some charts later on. So preloading needs to be looked at in the context of what it is. A quick gimmick that makes it look nice in practice accounts and demo accounts. But it's not a practical, long-term, sustainable approach that you can benefit from for a year or more without consequences. You must always remember to think about your trading for at least 1 year. Whether you are using a grid trading technique, an accumulation technique, or stop loss technique, it doesn't matter. You must have a long-term outlook in your trading to determine whether or not you're going to be truly profitable in that trading. So now let's go find some other examples of preloading not being all that great. USD Canadian is a good example of preloading not being that great of a situation. We can see the preloaded banks. We can see where it's already begun to stretch and flex within the market. When we see, though, where the market is, Preloading may or may not be beneficial in this consequence, and we'll see in the charts just what that means. We're about midway, which is pretty good, so we've got room for preloading to help us benefit. But eventually, this preloading is going to creep down to the bottom, the natural course for this particular trade direction. If you're in a long position, then the preload is going to creep to the top. That is, it becomes exactly opposite of what you wanted. You want it to go in your trade direction to benefit, but it doesn't. Now, there are ways, of course, that you can determine this. For example, looking at the market median, and if the price is below or above the market median based upon your direction of trade. And to keep this simple, I'm just going to use shorting as a direct relationship to what is on the chart. So in this case, if price is above the median, then I would preload, because at least then I have a contextual revelation of what that would be in the event of the market going in my favor. If the price is below the median, I would not preload, because I could potentially be in for a reversal where price is going to climb. So you can try to gain insight where you can gain some beneficial approach to preloading. For our third example, we're going to use the US dollar franc. And again, we see the classic combination of the preload, and then we see where the grid has expanded, which is all fine and well. Again, another clear example of the process doing what it's supposed to. But now let's look at the actual market again, and we see that we are very much in the bottom of the market. The other problem we can see right away with this whole system is we can see just how long the market stays below what would be the median. So we can see that preloading in this context is an extremely limited approach. Almost not worth the effort to really program it, to be honest. And that is often case the truth with any level of algorithmic sustainability that you may be building. You need to weigh out the amount of work you're going to put into building it versus the amount of time it's actually going to benefit your trading. In this case, the likelihood of it benefiting your trading is going to be once every 2 to 3 years. That's a bit extreme, and not something I would really recommend, to be honest. So preloading is great on paper. It really does a huge job. It can bring in some jaw-dropping, staggering profits. But the long-term process is a gimmick. And it is a gimmick in a way that really underscores just how much you can lose without even realizing it. So let's get into a few of the charts and see how this actually looks in terms of what the real trading approach sees. For a point of reference, I'm going to use my real money account where I'm not using preloading at all. This is just a simple 43 level stretched out grid that uses no gimmicks. And as you can see, since I've started this chart, it's made about $43 in trades. Not impressive, not something you do brag about with the bros at the bar. A very slow, steady, passive result. Exactly what it is supposed to be. Slow, steady, passive. No games, no gimmicks, no shenanigans. This is what you really want in your trading when you're dealing with a machine actually running your money for you. Remember, machines aren't human. They don't possess the cognitive abilities of a human. They can't be trained at the same level of a human, no matter how many gimmicks somebody tells you that AI can give you. It doesn't happen. You're not going to get to the caliber or level of a trader that's been in the business for 40 years. Discretionary trading is a different kind of mindset than algorithmic trading. You need to keep the two separated and think about the consequences of giving a machine your money. These are very important philosophies that have a very deep underlying connectivity and separation. So let's start getting into some of the bigger issues that we're going to be dealing with when you're looking at techniques like preloading. Okay, here we are looking at USD Canadian dollar, and we can see just what the chart looks like. Prior to preloading, slow, dull, boring, like my own live money account. It's not going anywhere very fast. It's just slowly ticking away, racking up profits over time. And then we see the benefit of preloading, the jaw-dropping impressiveness that this technique offers. Even if it does creep down to the bottom, it is impressive that it's literally doubled the amount of the account in basically what looks like a 24-hour period. And that is a critical component that you need to stay aware of. That this can really move money quickly. In fact, it's so impressive that I specifically zoomed in to the point when the preloading triggered in 3 different stages. Potentially a minor stage right in the middle. This is impressive. This is powerful. To go from $60 to over $140 in such a small time frame is just amazing. But this isn't the complete picture, and you need to be aware of that. Let's go into panning mode, and let's actually take a look at what happens. Let's shrink this up. And we see right away the first effect of preloading. That part of when the grid begins to expand and it starts taking stop losses. And in this case, all of those beautiful profits, it gave them back. Real world conditions. The downside of preloading when you're at the bottom or the top, wherever direction you want to be, and then the grid starts expanding. Here's what it really looks like. We see the regular mundane trades. We see the slow and steady proper approach. Then I turn preloading on, and then bang. It all comes back to bite in a vicious and aggressive way. This is why preloading is a gimmick, because every time you use preloading, this is the impact. At some point, you're going to become complacent, you're going to not turn it off quick enough, and it's going to start taking money back. Preloading is a short-term gimmick. It works great when the market is in your favor. But as soon as the market goes against you, it turns against you viciously. Now let's take a look at another example. This is an extreme case, but at the same time, it's a common case. The market sells off, you get lucky, and then it preloads, and the market goes against you aggressively. And you end up in the hole. And I really mean in the hole, because the grid now grows rapidly and you don't have the cushion of having all that built up profit from a good run. Remember, you have a 50% chance in the market for price to go up or price to go down. So right away, if you're preloading at the beginning, you have a 50% chance of coming out of a rock star like Australian dollar, US dollar did, or being absolutely decimated in the case of US dollar franc. It's not worth the gimmicks to try to get that short-term boost. It's better just to trade slow and steady and actually get profits in a sustainable approach. But now let's see what that looks like in the trading context, actual individual trades. For point of reference, I'm going to use my live money account, Cherry Blossom. These are my actual trades graphed out. Green means take profit. Orange means I lost money due to slippage. Red is a stop loss. And now we can see from here, we can see my entry points, we can see my exit points, and the slope of the green line. The sharper the slope, the less time I was in the market. For example, this trade here was a very short trade, but this trade down here is a very long trade. So this kind of a graph actually lets me visualize my trading in a meaningful way. I can see basically what looks like a mountain. I can follow the curvature and I can see exactly how the market is moving. And this is an important context of the market that as you work with your trading, you will see over and over when you graph it out in such a detailed manner. So let's get into the other two pairs that we were working with. And I'm going to first start with a pair that did excessively well with the preloading technique. Here it is, Australian dollar. This just rocked it with the technique. We see the normal trading pattern. We see that the market is trending downward. We see I took one stop loss, and then we see the impact of what looks like 3.5 cycles of preloading moving in my favor. Now this is the perfect condition in the right place, in the right time. I got lucky. And it really rocked it out. But this is not the normal standard case of dealing with a market. This is the normal standard case of dealing with the market. You can see my normal trading approach. Market dropped, market went up. Here we have the benefit of the preload, and then here all the stop losses took it back. The market giveth and the market taketh. Let's go in and zoom into this and actually see what this looks like close range. The nice thing about some of these charting tools is you can get nice and detailed with your analysis. So now we can see very clearly and closely, we can see the preloading technique really working. And we can see we went through 2 different preloads and it did fabulously well. As we saw in the equity chart, that big beautiful spike in profits from $60 to $140. And then in one big slam, as the market moved against us, it took all that beautiful money back. Claimed it, and then off it went. This is the reality of using any kind of a quick gimmick method. It just doesn't work long term because it's not sustainable. And here we see USD franc, and we see the same thing. But instead of getting the benefits of that upfront climb that we got from USD Canadian, this one just goes against us brutally and crushes the account. Preloading is a wonderful little gimmick if the market goes in your favor. If the market doesn't go in your favor, it will wreck you. It's not worth it. It's better to practice a stable, responsible, sustainable, slow and steady approach. You want your automated trading paradigm to be a turtle. Hares never win the race. The tortoise always does. Always. It does so because it can wade out the market. It can handle fluctuations in the market. It can deal with the fact that the market is going to dynamically change. Your trading needs to be always thinking about a worst case scenario. Always. Here is another example of where gimmicks can hurt you. This is one of my experimental accounts where I talk about and I've demonstrated a lot of different things on this account. And we can see every single time there's a gimmick approach, it just comes back and bites aggressively. Every single time. You need to understand as you trade that your trading must be sustainable. And by seeing a chart like this, by actually seeing your trades graphed out, you can see the bowing effect. That is, you can start here, it goes up, and it comes down, or a half moon effect. And you see that pattern over and over and over as the market goes through a cycle. This is one of the most important and most critical aspects of the Forex market. Those cycles really help give you a good indication of the market. And by studying those cycles, you can understand where you need to place your stop losses, your take profits, and how the market actually is going to fluctuate in such a way that you can become long-term profitable. Again, we can see examples of gimmicks. We can see where the market took a lot of hard losses, although this account doesn't have such aggressive gimmicks. Nonetheless, it still had some. And you can see when I turned off the gimmicks and I simply went to a more sustainable approach. We can see the reductions taking place. We can see how the market is moving, and we can see just how the bowing is still continuing even though the market is fluctuating up and down. This is now a sustainable approach. And the reductions play in by weeding out and raising the lower boundary of the grid every time the market makes a profit. So we are eating losses at the same time as making profits. That is, we have found a balance within the market that proves sustainability. Now, I've talked about grid trading, and you can see grid trading. But let's take this to one more layer. This approach is using Jackrabbit TV. It is using a combination of different indicators. For example, I started out using the cipher twister as strictly my buying process with a simple 20 pip take profit. Now I am using 3 moving averages as I've documented within the Patreon account. And we are going to go through and see how that does over the course of time. You can even see on the chart when I changed strategies. And we can see a proper, well-built, responsible system that is designed to weather the market. So whether you're using TradingView or you're using a dedicated grid technique, if you're placing multiple trades, then you're going to have some kind of a grid trading technique. Even if you're not in trying to get a grid trading technique, when you actually look at your trades, when you actually graph them out, realistically, any accumulation-based strategy is a form of grid trading. The only difference is instead of taking multiple profit levels, you're only taking one profit per the entire grid structure. But both work. Both are consistent and both are reliable as long as you're not greedy. As long as you plan out your worst case scenario. This system will work indefinitely. But you have to think about your long-term trading. There is no such thing as short-term trading, because even if you manage to get a large amount of profits, as we saw with a couple of the other examples, you have all those positions being held, which means you are either going to get negative finance rates on a daily basis, or in order to get out of those positions, you're going to have to take a huge amount of losses in your sales. So either way, you can't get out quickly. So whatever profits you made from those gimmicks are going to be taken one way or the other. Whereas here, using sustainable, low, passive methodologies, your profits are yours to keep because it will wade through the market over time, slowly and consistently. Now we can see Cypher Twister did a heck of a job. It just really rocked it out of the park. The risks for using this approach are of course slightly higher because it required more active positions. In this case, it required 76 active positions, or roughly about $280 of exposure to get this entire process done. And we can see it sold off, it started a new position, and then it sold off again. And here is where I changed the technique to use the 3 moving averages as my entry points. It's less aggressive and more suitable for what I'm currently testing. But nonetheless, you can see the sustainability and long-term practicality of this process. That is really the whole point of what you want. You want that sustainable, long-term practicality. I'm going to finish this conversation off by looking at the USD Canadian account and talking about the positions that I'm currently holding. Now this is the Blueberry Cobbler account where I used preloading with a 43 level depth for my grid. And these are the actual positions I'm holding right now, along with the current amount of finance rate actually accrued on each position and where that particular position is sitting in relation to my profit and loss ratio. Here we see that price of what I actually purchased it at, and because it's a negative number, we know I shorted it and the amount of units that I have invested in that single position. The thing to understand, preloading when you're using negative finance rates in your favor can be beneficial. Preloading when you're using an asset where you didn't study the finance rates is going to eat you alive. As you can see, some of these finance rates are just ridiculous. And you are going to be spending a lot of money on finance rates. But the real truth of this is what I'm holding right now. Let's say I'm in profit and I want to get out of it as quick as possible. Sell it off, take what I have, and walk away. Well, what you're looking at by looking at each position and how much that position is underwater, you're looking at $183 that I'm going to lose out of my account if I sell off right now. I have 28 active positions worth $183. So if I wanted to get out, I had better hope that whatever I have has made more than $183. And that is really where the gimmick of preloading hurts. Because once you get that big, huge, ripping bonus at the top, as soon as you get back in it, you're going to have all that weight to deal with. And all that weight is going to hurt. Because as soon as it preloads back up, and your time to be able to sell off and get into a preload is going to be very, very minor or very small. So if you can't get into that window before it starts buying again, you're going to feel the bite, just like this account did. this account suffered severely. And that is exactly why. So this is also why you have to think long term. Because you're not going to get out of a trading situation quickly. Not unless you're trading very small values, one position at a time. Remember, if you have a $1,000 account and you're only risking 1% at a time, you're only risking $10. This has got $183 of exposure, so that's its risk. And it can expect, within a reasonable approach, to make 20 to 30% over the course of a year. Emphasize a year. You have to understand long-term processing versus short-term gimmicks. Trading is about long-term sustainability. You could see YouTube, Twitter, Reddit, whatever, it doesn't matter. People pitching where they made $300 a day. Think about the risks they're taking. Think about how much they're giving back. All of those gimmicks will fail. You're not going to take and make 300% of your money without using gimmicks. And sooner or later, those gimmicks are going to take well over what you've earned. Trade responsibly. Think about the long-term process of your trading, and you will always come out on top. If you have any questions, please feel free to leave them in the comments below. If you're not subscribed to my Patreon, please consider doing so, and you get a lot of information where I talk about all of this stuff on a regular basis. My support server has a VIP area for subscribers that go into a lot of detail over time with all of this information. Please give this video a like, help it grow on YouTube, and thank you for watching. Until next time.